Okay, so you want to own a gold mine. You find a piece of land, drill into the ground, discover gold, bring in a fleet of enormous machines, and start selling metal at whatever the global market says it is worth that day. You do not need a brand. Nobody cares whether your gold came from a beautiful mine or an ugly one. You do not need to convince a customer that your product tastes better. An ounce of refined gold is an ounce of refined gold, and if the price is high enough, somebody will buy it. The gold is already underground. The market already wants it. Your job is simply to dig it up. That is the dream. Here is the problem. Most of what you dig up is not gold. It is rock. Millions and millions of tons of rock that must be drilled, blasted, loaded, hauled, crushed, ground, chemically processed, pumped, stored, and managed so that you can recover a few grams of valuable metal hidden inside each ton. And if those few grams are slightly fewer than your geologists expected, if the rock is harder than your processing plant was designed for, if fuel rises, if water becomes scarce, if a permit changes, or if the gold price falls at the wrong moment, you can stand on top of billions of dollars of gold and still lose billions trying to reach it. That is the strange economics of owning a gold mine. The gold can be real. The mine can still be a terrible business. Before we talk about profits, we need to talk about what you actually own, because a gold deposit and a gold mine are not the same thing. A deposit is geology. A mine is an economic system built around that geology. Somewhere beneath the surface, geological processes concentrated gold into rock. Your first job is to understand where that rock is, how much of it exists, how the grade changes from one area to another, and whether it can be extracted for less than the value of the metal inside it. That sounds obvious until you look at the amount of gold modern mines are often chasing. People imagine yellow veins running through black rock. Sometimes, rich ore really does look dramatic. Much of modern gold mining does not. A metric ton of ore can contain only a few grams of gold. 1 metric ton is 1,000 kilograms of rock. Imagine loading a small car with stone, crushing every piece into particles, processing all of it, and ending with an amount of gold small enough to hold between 2 fingers. That can still be profitable because gold is valuable enough that a tiny concentration matters. But this is the first thing nobody tells you when they picture owning a gold mine. The gold is the revenue. Every piece of rock around it is the bill. The industry measures this concentration as grade, usually in grams of gold per metric ton of ore. A mine averaging 2 grams per ton is not automatically better than a mine averaging 1 gram. Grade matters enormously, but it is only one variable. A lower grade deposit near the surface may be mined cheaply with a giant open pit. A richer deposit deep underground may require tunnels, ventilation, pumping, ground support, and specialized equipment. One mine may recover most of its gold through a relatively simple process. Another may contain gold locked inside minerals that are expensive to treat. One deposit may sit beside roads and power lines. Another may sit at high altitude, hundreds of miles from meaningful infrastructure. So when a mining company says it has found gold, the correct question is not how much. The correct question is, at what cost? This is where cutoff grade enters the business. Cutoff grade is, in simple terms, the economic line separating material you treat as ore from material that is not worth processing under the assumptions in your mine plan. The rock on both sides of that line may contain gold. The difference is whether the expected value of the recoverable metal justifies the cost of mining and processing it. If gold prices rise, material that looked unattractive can become more interesting. If fuel, labor, explosives, or processing costs rise, material that looked profitable can fall below the economic line. The gold underground has not moved. The financial definition of ore has. This is one of the strangest parts of mining. A company can own exactly the same deposit and, after changing its gold price or cost assumptions, report a different economic picture. Geology is physical. A reserve is partly economic. And before you reach the reserve, you have to spend an enormous amount of money figuring out what is actually there. Exploration begins with maps, old records, satellite information, geochemistry, geophysics, fieldwork, and geological theories about how mineralization formed. Eventually, you drill. A drill rig cuts deep into the ground and removes cylinders of rock called core. Geologists study the core, log the rock types, mark structural features, cut samples, and send them to laboratories for assays. The laboratory tells you how much gold appears in each sampled interval. Then you drill another hole, and another, and another. A single spectacular result can create excitement, but it does not create a mine. One hole may hit rich material. 50 meters away, the next may find almost nothing. Another shows lower grade. Another hits a fault. The deposit slowly becomes a three-dimensional model, reconstructed from narrow holes passing through an enormous volume of ground. You sample tiny parts and estimate everything between them. More drilling reduces uncertainty, but the business still begins with rock you cannot fully see. And drilling is not free. Crews, rigs, roads, camps, helicopters in remote regions, laboratories, environmental studies, and years of technical work can consume tens or hundreds of millions of dollars before a company decides whether to build anything. Most exploration targets never become mines. Some contain no meaningful gold. Some contain gold in the wrong shape, the wrong grade, the wrong location, or the wrong mineralogy. The money spent learning that is simply gone. This is why the mining industry separates mineral resources from mineral reserves. A resource says there appears to be valuable material with reasonable prospects for extraction. A reserve is the economically mineable part after mining, processing, infrastructure, environmental, legal, and economic factors are applied. In plain English, one says the gold appears to exist. The other says part of it may support a viable mine. That distinction is everything. You can discover gold without discovering a mine. Mining companies have announced deposits containing millions of ounces that remain undeveloped for decades because the capital cost is too high, the permitting is too difficult, the grade is too low, the infrastructure is missing, or the expected return is not good enough. Investors see the number of ounces and mentally multiply it by the gold price. 10 million ounces times several $1,000s sounds like tens of billions of dollars underground. But the company does not own tens of billions of dollars in a vault. It owns the possibility of spending billions to build a system that may recover some of those ounces over many years, while paying every operating cost along the way. Contained gold is not revenue. Recoverable gold is not profit. That is the trap. Say the exploration results look strong, the resource is large, engineers complete studies and decide the project might work. Now you have to choose how to mine it. If the ore body is near the surface and shaped appropriately, you may build an open-pit mine. The basic idea is simple. Remove the rock above the deposit, drill and blast the material, load it into enormous haul trucks, separate ore from waste according to the mine plan, and send the ore toward processing. In reality, an open pit becomes one of the largest artificial holes a business can create. Roads spiral down the walls. Benches are cut into the rock. Fleets of trucks move constantly between shovels, crushers, stockpiles, and waste dumps. A single large haul truck can cost millions of dollars. Its tires are enormous and expensive. It burns fuel while carrying hundreds of tons at a time. The truck does not care whether the load contains gold. You pay for the trip either way. And that creates a number called the strip ratio. The strip ratio tells you how much waste material must be moved relative to the amount of ore mined. Suppose you need to remove 3 tons of waste to access 1 ton of ore. Those 3 tons still need drilling. They still need explosives. A shovel still has to load them. A truck still has to carry them. The road still has to support the weight. Diesel still burns. Tires still wear. Workers still get paid. Then the waste is placed somewhere and managed. It produces no gold revenue. Before you can move the rock that pays you, you may have to move several times more rock that pays you nothing. This is why 2 open-pit mines with similar grades can have completely different economics. One may reach ore near the surface. Another may spend years cutting through waste before reaching its best sections. Engineers therefore mine in phases, deciding what reaches the plant, what lower-grade material is stockpiled, and how much waste must be removed now to expose future production. A mine can report strong profit this year while spending heavily to uncover weaker ore for the next several years. Look only at the current ounce, and you may miss the cost of the next one. Underground mining creates a different problem. A deep or narrow ore body may require tunnels, ventilation, pumping, ground support, and specialized equipment simply to reach the rock. Water has to be removed. Heat and ventilation become more difficult with depth. Ore must travel from underground to the surface before processing begins. In exchange, the mine may reach higher-grade material while moving less total waste than a giant open pit. There is no universally better method. There is only the mine the deposit allows you to build. You cannot move the gold closer to a highway or ask an ore body to become wider so your equipment fits. The geology does not negotiate. Once the ore is mined, you still do not have gold. You have smaller pieces of rock containing gold. The processing plant crushes and grinds that material, then uses a method suited to the ore. Some lower-grade deposits can use heap leaching, where a cyanide solution moves through crushed material and dissolves gold. Other deposits contain refractory gold locked inside minerals that require much more expensive treatment. The geology that determined how you mine the deposit also determines how difficult the metal is to recover. More difficult ore means more equipment, more energy, more chemicals, and more capital. This is where recovery rate becomes critical. Suppose the geological model says 1 ton of ore contains 2 grams of gold. That does not mean 2 grams becomes saleable metal. If the process recovers 80%, you get 1.6 grams. The remaining gold was real. It was physically in the ore. It simply did not become your product. Multiply a small recovery difference across millions of tons, and the financial impact becomes enormous. A plant designed around 90% recovery that consistently achieves 85% is leaving a meaningful share of expected revenue behind. The rock can also change as the mine gets deeper or moves into a new section. Harder ore reduces throughput because the mill cannot grind as many tons in the same time. Different mineralogy can consume more reagents. Clay can create handling problems. Recovery can fall. A mine built from years of geological and metallurgical testing can still discover that actual operating conditions are less cooperative than the models expected. This is why a gold mine is not simply a hole with trucks. It is a factory whose raw material changes every day because the factory is consuming a natural deposit instead of standardized parts. You can control the plant. You cannot manufacture identical ore. Now, let us talk about the number investors obsess over: cost per ounce. At first, the model sounds beautifully simple. Gold sells for one price. You produce an ounce for a lower price. The difference is your margin. But which production cost are we talking about? Mining companies use several measures, and one of the most watched is all-in sustaining cost, often shortened to AISC. It goes beyond the immediate cash cost of mining and processing by including spending required to sustain current production, such as sustaining capital and certain mine site and corporate costs. That matters because mines consume their own equipment and infrastructure. Trucks need replacement, plants need maintenance, new sections need access. The cost of today's ounce can look attractive, while the cost of keeping tomorrow's ounce available is much higher. In the fourth quarter of 2025, Newmont reported gold co-product all-in sustaining costs of about $1,620 per ounce. Major producers can report very different costs by mine and by period, and that is the point. A gold mine does not earn the gold price. It earns the spread between the realized value of its metal and the full cost structure required to create saleable ounces. If gold sells for $3,000 and your all-in sustaining cost is $1,500, the margin looks enormous. At 500,000 ounces, a $500 change in margin represents $250 million. Small movements become huge at scale. This is why rising gold prices can make mining companies look spectacular very quickly. The trucks did not suddenly become better. The ore body did not become richer. The processing plant did not learn a new skill. The product simply became more valuable. But high gold prices can also hide a weak mine. Grade falls, the pit gets deeper, haul distances and strip ratio rise, the ore becomes harder, recovery slips, the fleet ages. If gold prices are rising at the same time, the mine can still produce strong cash and management looks brilliant. Then the metal price stops rising while costs continue upward. The margin suddenly compresses. Everyone says the mine had a bad year. In reality, the asset may have been weakening for 5 years. The gold price simply covered it. There is another problem that makes gold mining different from almost every business we have discussed on this channel. A successful mine is slowly liquidating itself. A hotel sells the same room again tomorrow. A casino can use the same table for the next customer. A shopping mall collects rent from the same square footage year after year. A gold mine sells part of its productive asset every time it ships gold. Once an ounce is mined and sold, that ounce is gone from the reserve base forever. The operation can improve recovery. It can lower costs. It can discover more gold nearby. It can convert resources into reserves. But it cannot sell the same ounce twice. This is why exploration is not a side department full of geologists spending money because rocks are interesting. Exploration is an attempt to find the next years of business before the current years disappear. If you produce millions of ounces every year and do not replace them through discovery, development, or acquisition, the company is shrinking underground even while the income statement looks healthy above ground. This creates a brutal choice. You can spend heavily on exploration with no guarantee of success, or you can buy another mining company that already has reserves and pay a premium for the work somebody else completed. Either way, replacing the asset you sold costs money. Production is success today and depletion tomorrow. The same ounce creates both. Nowhere is the difference between gold in the ground and a profitable mine clearer than Pascua-Lama. Pascua-Lama sits high in the Andes on the border of Chile and Argentina. It was a giant gold and silver project controlled by Barrick. In 2009, Barrick announced that it was moving ahead with construction. The numbers were extraordinary. Proven and probable gold reserves of 17.8 million ounces, with hundreds of millions of ounces of silver contained within those gold reserves. An expected mine life of more than 25 years. In the first full 5 years, Barrick expected average annual gold production of roughly 750,000 to 800,000 ounces, along with about 35 million ounces of silver. The expected pre-production construction cost was around $2.8 to $3 billion. The silver was especially important because revenue from selling it was expected to offset part of the cost of producing gold. On paper, Pascua-Lama looked like the kind of asset every gold company wants. Huge, long-lived, and potentially very low cost. This was not a speculative hole in the ground with one exciting drill result. Construction moved forward. Barrick began committing billions of dollars. Then, the estimated costs started moving. In early 2011, expected pre-production capital increased to around $3.3 to $3.6 billion. Barrick cited pressure from currencies, labor, commodities, input costs, and inflation. A few months later, the estimate moved again, this time to roughly $4.7 to $5 billion. The company pointed to inflation in key consumables and labor, revised estimates for steel, cement, fuel, and equipment, and additional spending intended to maintain the construction schedule. The gold had not disappeared. The bill surrounding the gold was getting larger. By the third quarter of 2012, a broader review indicated the capital costs could be closer to $8 to $8.5 billion, with first production delayed into the second half of 2014. Barrick said the increase reflected schedule delays, more labor hours, and different installation rates than expected, and additional project and construction management costs. Think about what happened to the original equation. A project expected to cost around $3 billion was now approaching 3 times that amount. The mine had not produced its first commercial ounce. Every additional billion had to be financed or funded by the company before the asset could begin generating operating cash. By the end of March 2013, Barrick said approximately $4.8 billion had already been spent. Parts of the infrastructure were well advanced. The tunnel was mostly complete. Structural steel had been erected at the process plant. Concrete had been poured. This is the most dangerous stage of a mega project because the money already spent creates psychological pressure to keep going. You look at billions invested and think stopping would waste all of it, so the next billion feels easier to justify than the first. But the mind does not care how much you have already spent. Future cash flow only cares about what remains to be spent and what the finished project can earn. Then, the regulatory and environmental problems became impossible to separate from the financial ones. In 2013, work on the Chilean side was affected by orders and requirements connected with environmental compliance and water management. Barrick eventually suspended construction, except for work required for environmental and regulatory obligations. The project moved into care and maintenance. In the second quarter of 2013, Barrick recorded an after-tax impairment charge of about $5.1 billion against Pascua-Lama. A project once presented as one of the industry's largest and lowest-cost future mines had become the source of one of the largest write-downs in mining history. And here is the part worth remembering. The gold was real. Barrick did not spend billions because geologists accidentally imagined 17 million ounces. Years later, the company still described Pascua-Lama as containing substantial gold resources, while saying later concepts did not meet investment criteria. At one point, an underground concept was studied and found technically feasible, but it still failed the investment test. That is the entire gold mining business in one sentence. Technically possible does not mean financially worth doing. Pascua-Lama had gold. It had engineering. It had partially built infrastructure. It had billions already invested. None of those facts automatically created an economic mine. The project failed in its original form because the cost, execution, regulatory, environmental, and investment equation changed around the deposit. The gold was real. The mine, as originally promised, never became real. And even when a mine does work, the owner faces a problem Pascua-Lama never reached. The asset gets smaller every time it succeeds. Every ounce sold reduces the reserve base. Exploration can extend mine life, but it can also spend millions and find nothing economic. A mine can be profitable and productive while moving steadily toward the day when there is not enough ore left to justify another shift. This is why mine life matters. Two properties can produce the same number of ounces today, while one has decades of reserves and the other is approaching its expiration date. And when the final economic ore is processed, the bill does not end. Waste dumps and tailings remain. Pits can fill with water. Underground openings require closure. Buildings may need demolition. Disturbed land and water can require treatment and monitoring long after production stops. The last ounce is not the last expense. The gold may sit in a vault for 100 years without changing, while the mine that produced it continues costing money after production ends. Closure has to be priced before the first ounce is sold, not after the last one. So if you do decide to own a gold mine, understand what you are actually buying. You are not buying a mountain full of money. You are buying a geological estimate, a processing problem, a construction project, a commodity price exposure, and an asset that consumes itself every time it succeeds. You have to prove where the gold is, build a mine around rock that will never adapt to your business plan, move millions of tons of material that may produce nothing, recover less metal than the ground technically contains, replace the reserves you destroy through production, and keep enough money aside to deal with the property after the final profitable ounce is gone. The gold can be worth billions underground and still be worth almost nothing to you if reaching it costs more than the market will ever pay back. You are not buying gold. You are buying a very expensive machine for moving rock and a financial bet that the few grams hidden inside each ton will remain worth more than everything it takes to reach them. If you want more breakdowns of what expensive businesses really earn behind the scenes, subscribe to Money Anatomy.